Chapter 10 has somewhat of a, plain title. Doesn't inspire too much enthusiasm. Capital budgeting techniques. I think a better way to think about this is your company is about to make like a humongous investment or a number of investments, and which one or which set of investments should you undertake? And that's like a really big question. And with basically the whole company's success riding on these major outlays of cash or capital devoted to them to see if they make your company a lot of money. So we'll look at various measures. I think this one thing about this chapter we'll bring out too is that there's some creativity involved. It's not a simple matter of purely ranking. Even when you have a number of projects or investments that you can undertake, it will also matter how they complement each other. So without further ado, let's jump into Chapter 10. So capital budgeting is looking at these long-term investments. So a capital investment is distinguished from shorter-term expenditures like operating expenditures, which are a couple things. One, they tend to be relatively within the short horizons, maybe within a year, and also they're more normal, ongoing, planned. Capital budgeting in a personal finance example would be more about buying a home, buying a car, going to college, okay, paying for college, that is. So it's these big decisions, not so much about what the grocery bill is for this week or how much our utility is going to be for this year. Well, they kind of are what they are, but it's these big ideas that we'll be talking about in this chapter. So there's 5 steps in the capital budgeting process, fairly similar to general, decision-making or problem-solving steps. The first one is you got to come up with possible solutions, so to speak, or opportunities. Secondly, they need to be vetted and understand what their potential is in terms of making money for your company. Then it needs to be decided. So it could be buying a car, okay, for a company that probably isn't a capital expense unless it's a small company, maybe a fleet of cars. For a person, that would probably be a big capital decision. So ultimately, they need, in the third step, they need to decide how much to devote to, say, various transportation methods: car, boat, motorcycle, bicycle. Okay. Fourth, then the decisions have been made. Now the money flows and the project is built. The idea of a capital project is not only are they big dollar amounts, but a lot of times they involve multi-year commitments, building a factory, or here at Asbury, building a new STEM building, as we hope to see in the next year or two. And then the fifth step is, well, how did it work out? Okay. And since it's longer term, maybe the person that gave the green light on this is no longer with the firm, but typically we'd think they are. And they're evaluating how things worked out. And since it's real life, it may be better, maybe worse. But even at some point, and I think it's touched on some of this chapter, you reach kind of a midpoint in the development of a capital project, and sometimes it should be X, a lot of times it's not because the manager doesn't want to admit a mistake. But we have this with the the Boston Big Dig, I think it was called, building subways under the city, or was it subways? Something underground, and it was supposed to cost, I don't know, $5 billion. It ended up costing like $100 billion or something, way out of budget. But once it got rolling, there was no stopping the politicians and business people, I suppose, that wanted these new infrastructure built. So anyway, we'll look at many examples throughout this chapter, and let's proceed. So an important idea in capital budgeting is how are we going to keep score or rank the potential projects or investments? And one common one is the payback period. And it's just that. How quickly do we expect to earn back our initial investment, assuming it's a one-time lump sum investment, to have paid back the amount, okay? So I think in the next slide or two it talks about some weaknesses of this, but intuitively it sort of makes sense that we want to break even as soon as possible. But one weakness of this is, well, you're not in business so much to break even. I mean, maybe so, but ultimately you're interested in doing much better than breaking even. So a made-up example, one project may break even in 2 years, but then have relatively modest future profits. A second project may not pay back for, say, 10 years, break even that is. But after that, it really starts to take off and has fantastic returns. So sometimes patience is a virtue. It's not always we want to break even as soon as possible. Ultimately, you have to have some early returns from some of your projects, but ultimately it's about the long run view of what a project may return. A second method of evaluating a project or comparing across different potential projects is net present value. So it comes back to essentially the same ideas we saw when we're doing bond or stock valuation, is we want to find out what is the net present value. So the idea of net is, well, we're going to subtract off the cost associated with it, and usually a big cost is that upfront development cost of building a factory, say. And then the future cash flows, which are hopefully positive on net anyway, are from the sales and profits that are generated from the new product or new factory or whatever it may be. So this is very intuitive. Unlike the payback period, this is focusing really on the full horizon. A challenge of this is mathematically it's pretty simple, at least within a spreadsheet. Even if you had 30 years of cash flows or what have you, you just discount them back. The real question is, for the manager or for anyone interested in this, is, well, how accurate? It's easy to come up with pie in the sky. Oh yeah, I'm going to write a book and I'm going to generate $10 per copy and sell 10,000 the first year and 20,000 the next, and then it's going to hit the New York Times bestseller list. And anyway, so the challenge and where the real analysis comes in is having accurate, or at least maybe a distribution of what those cash flows could be. In the simplest form, we use a very cut and dry criteria. If the net present value is positive, then that's a good thing. If you're going to decide on something and the benefits are greater than the cost, accounting for present value and measuring all the benefits and costs, which for most business examples are at least potentially we're able to identify. It's a little more challenging for something like a public park or a new major at Asbury, where it doesn't necessarily generate money flows as much as it creates opportunities and what have you. But that's neither here nor there. Okay. This again is a very popular method to rank stuff. One challenge again is you have to have accurate future cash flows or projections of them to decide whether this project is worthy or not. A particular company. Sounds pretty common standard English to be trademarked, but anyway, it's similar to net present value, but the hurdle isn't necessarily that it has a positive net cash flow. It actually there's a little higher hurdle, and that is it needs to have a profit above a normal rate of return. So there's some, I guess, ambiguity about what is normal. One simple measure would be within an industry, what is typical. So in the pharmaceutical industry, it may be fairly high. In something like food, Kroger's and what have you, groceries, that is, it may be a relatively low profit margin that has to be established. The internal rate of return is a huge idea in finance. Essentially, it is taking our present value formula and saying we know everything except the return. So in a lot of ways that flips typically how we probably think about many finance problems where, well, we know the return on a bond or we know the interest rate on a mortgage. We want to find out what the payment is, say. Well, the internal rate of return, the internal part is just essentially that's what we're solving for. And it gives us an answer. So it can say, well, if we did have these cash flows, what would be our, it goes back to our ratios. It's more or less the profitability ratios, but we're actually figuring it out within a cash flow setting rather than pulling it from our accounting statements. The decision rule for using internal rate of return to decide whether to green light or red light a project is basically a benefit cost analysis. So the internal rate of return or profitability, we could say, if that's greater than what it's costing us to fund that through, say, selling bonds or raising money through equity markets. So if the IRR is greater than the cost of capital, go for it. Okay. If it's less, then benefits don't cover the cost. the two most popular decision criteria are net present value and the IRR. You might say, well, why do we need 2 or 5 different techniques, as it may be? Well, one reason is they don't always tell the same story. So a project that gets a green light with the NPV may get a red light with the IRR. And if we're looking at a number of projects, they're not necessarily going to be in the same order A, B, C. One could have B, C, A, all right? Typically, I mean, if you really truly have a fantastic project or opportunity, the rankings or the methods are going to give the same ranking or strong green light or strong red light. If a project just, it's going to cost a lot of money and probably not generate much revenue, well, we don't need any fancy spreadsheet finance model to decide on that. But there's some more subtle things within here. So this slide points out one difference is what they assume about what's going on during the project with cash flows. That is, are they being reinvested, or are they able to earn at the cost of capital, which, if it's a good project, should be lower than the IRR, or are they being reinvested further in the project at this higher internal rate of return? So that could cause some problems. I don't think in general it's a huge issue. Ultimately, I think the bigger challenges in these projects or in these rankings is to accurately, not perfectly, because it's the future and it's unknown, but to have good estimates of what the cash flows could be. So for some industries that may not be terribly difficult if it's relatively established, if other people have done similar things, so to speak. If it's say a startup with, to develop the next app and they think it's grand and they may sell 10 or they may sell 10 million of these, or they may give away 10 million and still be valued very high. So that I think is the much greater challenge rather than picking between conflicting rankings.